You deserve the best life. You work hard. You know the formula for success. Your options are wide, but few make the cut. We can help you make the most out of life. Because you deserve the privilege that comes with building an elite life. Introducing Manulife Affluence Max Elite. This one-time investment in life insurance plan provides you with a startup bonus that would optimize your funds on the onset, so you can enjoy rewards now and in the future. Experience the Manulife Affluence Max Elite Advantage. Let's say you put in a one-time investment of 1 million pesos. Manulife will give you 1% of that as a startup bonus. This increases your investment by 10,000 pesos. Assuming that the funds grow by 8%, your investment can grow to almost 5 million pesos. Get a loyalty bonus. If you stay invested, you may have the chance to get a loyalty bonus on the 10th, 15th, and on the 20th year. Enjoy hassle-free application through a guaranteed issue offer. This means that there would be no need for medical examinations if certain conditions are met. Get a boost on your investment by making additional investments anytime. Enjoy peace of mind with life insurance coverage. Invest through Manulife Affluence Max Elite. Get an early reward and look forward to more. You deserve the best life. You work hard. You know the formula for success. Your options are wide, but few make the cut. We can help you make the most out of life. Because you deserve the privilege that comes with building an elite life. Introducing Manulife Affluence Max Elite. This one-time investment in life insurance plan provides you with a startup bonus that would optimize your funds on the onset, so you can enjoy rewards now and in the future. Experience the Manulife Affluence Max Elite Advantage. Let's say you put in a one-time investment of 1 million pesos. Manulife will give you 1% of that as a startup bonus. This increases your investment by 10,000 pesos. Assuming that the funds grow by 8%, your investment can grow to almost 5 million pesos. Get a loyalty bonus. If you stay invested, you may have the chance to get a loyalty bonus on the 10th, 15th, and on the 20th year. Enjoy hassle-free application through a guaranteed issue offer. This means that there would be no need for medical examinations if certain conditions are met. Get a boost on your investment by making additional investments anytime. Enjoy peace of mind with life insurance coverage. Invest through Manulife Affluence Max Elite. get an early reward and look forward to more.
Hello everyone, I am Eileen Janicio welcoming you to Manulife Philippines webinar, Growing Wealth Beyond Borders. Do you know that there are different types of investments? My personal favorite is an investment-linked life insurance plan because this plan gives life protection coverage and the possibility of higher returns in the future. This is also known as a variable unit-linked plan. Now, before we start, we want to know if our audience here today are familiar with this type of plan. Flashed on your screen right now is our first poll question of this afternoon. Do you know how an investment-linked life insurance plan works, how it works? So please don't be shy, please key in your answers. Please answer yes if you do and no if you don't. Let us know how you guys, how much you know about our investment-linked, unit-linked insurance plans. So are we seeing movements here? Yes, we do. Wow, so far so good, guys. Thank you. Majority of you are answering yes, and that's good news for all of us here at Manulife Philippines, and good news also for all of you because this means you will get to appreciate this session all the more. Okay, so a variable unit link plan gives you freedom to choose where you want to invest a portion of your premium to. Along with that, it can also provide you with a stream of income payouts that you may use for emergency purposes. It can also be invested locally or even across the globe. Now, did you know that you can diversify by investing in offshore funds? This can offer you a host of benefits from increased protection of your wealth and potential tax advantages. So I'm sure you'll want to hear more about this. That is why we have invited 3 subject matter experts this afternoon. Our first guest will help us understand what investment-linked life insurance is about and how it can help us earn and save more when we invest in offshore funds. Furthermore, we'll hear about the market outlook for 2021 and learn about Manulife's newest fund offerings. Throughout the program, if you have comments or questions for our speakers, go ahead and send them via the Q&A box at the bottom right side of your screen. And later on, our guests will address these questions in the Q&A session. Okay, so let's go right to the program by introducing our first speaker. He is the president and CEO of Rampver Financials, a serial entrepreneur with companies and endeavors in multiple industries. He's the lead independent director of Globe Telecom and Ayala Land Logistics Holdings Corporation, and an independent director for Ayala Land and National Reinsurance Corporation. He is also the chairman of the Soldivo Funds and director of Esquire Financing, Seedbox Technologies, the Blue Leaf, the Kulilan Group, and Mobile Group Incorporated, to name a few. He is also a best-selling author and a business, leadership, and financial advisor and mentor. Ladies and gentlemen, please welcome Mr. Rex Mendoza. Good afternoon, Rex. Thank you for joining us today.
Thank you. Thank you so much, Eileen. It's an honor and a privilege to be here. Thank you so much, everyone, for making me a part of your day. This is really going to be exciting because obviously there are a lot of things to do on a Monday afternoon and you elected to be here. So let us make this an enlightening, interesting, and learning session for all of you. So the focus, as Eileen mentioned, of my talk will be what's happening out there. I mean, let's take a look at markets, the possibilities for investments, and drill down how to probably make this impact us positively through our investment journey. See, maybe many of you are going to be thinking, isn't this a wrong time to actually think about investing? It's so problematic. We see another surge. We hear about surges in other countries. Is it really a good time to invest? And for those of you who are following markets, you would have noticed the Philippine market is in the doldrums for quite a number of months now, from a very strong January. First few days, really strong. Plummeted from there, and somehow directionless with a high degree of volatility moving forward. But then, what's the real question here? The real question is this. Can I move on to that next slide? The next issue is this, the fact that we have to straddle growth and risk every time. See, it doesn't really change the type of accountability and responsibility that we have. Achieving financial objectives is a must regardless of what's happening. We cannot make it as an excuse like, oh, of course, there's a pandemic, so I can't retire next year. So if your goal is to retire in a certain particular time, you have to be able to meet that. Obviously, some of you are bringing kids to school. Somebody is going to go through college. You cannot postpone that just because we're in the midst of a pandemic. So perspective change happens when you look at investment horizons, that we actually make decisions not for the short term. We make decisions for the long term. Long-term objectives always changes the way those horizons go. So inevitably, we find out it is really a responsibility that we have to be accountable, and because of that, we have to have the right discipline and strategy. And that's exactly the reason why we're all here. Next slide, please. See, all the business outlooks that you can possibly attend, whether it's done by a Philippine capital market practitioner, a fund manager, or even somebody who's in a foreign market or serving probably the global scheme of things. All of these four would be very, very consistent. The fact that there are themes within 2021 business outlooks. Number one theme, that it's going to be a tale of two halves. A tale of two halves. The first 6 months will definitely perform very differently from the last 6 months. And why is that? It's because we're experiencing what we're experiencing. We're in the midst of, having a vaccine, but having variants amidst, all our environments. So you will see people getting spooked with the probable bad things that can still happen in the market and in the business environment. However, the flip side of that is this, that we know that there's already a vaccine, and vaccines are getting manufactured as we speak, and people get inoculated and vaccinated as we speak. So certainly, the tail end of the year would probably be very, very different than the tail end of last year, where we had no vaccinations, where we had no vaccines whatsoever. So there would be a change in market sentiment very clearly between the first and the second half of 2021. Next theme is this. You don't hear about the V-shaped recovery or the L-shaped recovery or the U-shaped recovery anymore. We hear oftentimes of the K-shaped recovery. And for many of us, let's talk about that. Why it has all of a sudden become a K? Because clearly it's a very different scenario. Now, you don't have the entire economy recovering, much like in the past crisis. For this particular situation, we're in a pandemic, so some industries are going to be recovering much faster than others. So there are companies that are going to be recovering and not even waiting for the vaccines to happen. And these are the companies that are in technology, essential retail, and even software services. They're already up there. And that's a reason why other markets are performing better than ours. If you're going to be looking at the cross-section of the Philippine Stock Exchange, how many technology companies can really talk about? There's not much, not enough, unlike other more advanced and sophisticated markets. However, the other leg of the K is the industries that are going to be in the doldrums will be expecting some help before they recover, will take a bit of more time. And these are the companies that are in the hospitality business. These are the companies that are in travel, in food services. Before, we open up and maybe open the doors of our malls to more people out there. So the K-shaped recovery is real. The third thematic across all countries of the globe will be inflation. Many institutions, many governments are handing out cheap money. This is the way we help. And in the Philippines, we term it as ayuda. Where did that money come from? That's cheap money distributed throughout many people. In the US, they distributed paychecks of $2,000 each. So certainly, this can be inflationary. And that's the reason why, as investors, we are put in a very precarious mode. So much so that we need to be more creative in the way we handle our money. And why should I say it's a must? It's because we're going to be losing money while we're saving it. It's very clear all across the globe, because of all of these stimulus, because of all of the money that's getting pumped, the liquidity getting pumped into economies, we are going to be seeing inflation, and the people are going to be holding cash, and cash-like instruments might be hit with the loss of purchasing power. And that leads me to the last theme, which is the search for yields. Much like you, I am in search of probable instruments that can give me better yields, that can give me a better chance to fulfill my financial goals well into the future, despite the pandemic, despite what's happening out there. Because as I've said, we have to reach our dreams, our goals, despite of what's happening. So we move on to really say that this is what we're going to be seeing this year moving forward. Next slide, please. The global economy, because of how bad 2020 was, is projected to really move strongly in 2021, surge in 2021. But why aren't we seeing that? Because the sentiment isn't there. The positive sentiment is not supported. The second half, most probably, as we get more vaccinations happening. So technically, you will see a surge, but there would be a normalization by 2022. After every drop, you see a strong recovery, and after that, a normalization. But the timelines won't be equal for all countries. It will be dependent on all of these factors. The continued stimulus support, and I can say it's much, much better in other countries. The sovereign debt stock that's really going to be there to increase because, again, balance sheets of countries are going to be tested. There would be a compounded difficulty in debt service, especially for third world countries. There has to be, a step up in terms of virus control. And obviously, even industries have to be restructured for productivity. Next slide, please. So you're going to see the world performing this particular way. Globally, we're good. But what you're going to see is that some countries are going to be doing better than others. Let's concentrate on emerging and developing Asia. That's where you see the big numbers. And whether we like it or not, I know that press-wise, they have gotten it too negatively recently. China is leading the way in world recovery. But much of the world, including the Philippines, because of what we all hear, because of what's happening to our own West Philippine Sea, kind of gives them quite a negative perception. But economy-wise, we cannot neglect the fact that they're quite ahead. Maybe also because they started this whole thing. So they recovered very early from where they were. We're just going through the same process as they did. If you're going to be looking at the United States, solid returns. But you see, the plus with the US is because of the way they can handle money supply, the Fed, and the support that you're having from a newly installed president. If you have a newly installed president, you'd really like to tell people, make them feel that they made the right choice. You wouldn't want them to get down into, the crisis belly up, you are going to be helping both institutional and even families within your country. And if that means borrowing more money, getting into a higher level of deficit, you will attend to that issue later on. But the more important thing is to get that positive energy, that positive vibe. And you see the US is having that right now. They're, just hitting strides in terms of all-time highs. Not only in terms of the Dow, it's also the Nasdaq, and of course the Nasdaq, and even the S&P 500. So if you're going to be looking at emerging Asia, China's big there. You're going to be looking at the United States, and exactly, the global picture altogether also pretty strong. Next slide, please. So the first half of 2021, we're going to be seeing the economic rebound to accelerate with above-trend growth because of pent-up demand. There is pent-up demand. I will be showing you a chart later of how people are going to be saving within the pandemic. And let me tell you, they're going to be spending a ton of that after we become more confident in getting out. We become more confident in our economies. High liquidity through the fiscal monetary stimulus, despite of inflation fears, that will continue. That will continue. It's a must. And lastly, the turbocharged structural trends, which is e-commerce and sustainable investing. Again, if you're going to be seeing that as a thematic globally, the Philippines will be in a very precarious situation because we don't have too much of technology companies and we don't have too much as well of sustainable companies. Again, we're a third world country. It's not our fault. But if that's going to be a thematic that fund managers will follow and will make it a very important ingredient in future investing, we have to do a bit more in terms of structuring for some of our companies to be popular. So for the Philippines, reality bites. Next slide, please. The reality bites, and we will have to see this. The restart and recovery will take a little longer than expected. You've seen charts. I'll show you some later on. You will see how we've been a laggard, so to speak. Recent infection surge and stricter lockdowns impact economic trajectory. That's what's hurting us so much. We had very, very strong lockdowns, but we still had the surges. In many countries, they did not have the lockdown. They had a surge, but they were able to, make that economy hum while the surge didn't happen. For us, we got the raw side of both deals. We had a strong lockdown, a very strict lockdown, and a surge to boot. So it's almost like 1 year is over and we're still within, phase one. Pace of vaccination much slower than ideal, in need of acceleration. So this is something that has to happen, but does it happen only after the first world countries have done this? Next slide, please. You will see these charts, the storyline that we have, the kind of surge, that we experienced first half of this year. And you see, the sad plight is the fact that we have been compared to our neighbors, not just globally, just with ASEAN neighbors. And you will see where Indonesia, Singapore, Myanmar, Thailand, and even Vietnam, you see where they are. And it's almost like we're going the opposite direction. And this, more than just hampered the real health issue. It has become an economic and investment issue. Much of fund managers took out capital. We had a lowering of our exposure to the MSCI, which you will see probably will end this week, but still a trending downwards because international fund managers have to sell out the Philippine market to make room for whatever they're adding into those level or indices that are followed by fund managers globally. Next slide, please. So you're going to be seeing the impact, and that impact is a negative 15%. So yes, 15%. From a high of 7,300 start of January, we're at about 6,200. This was last Friday. So if you're going to be seeing this, that's a 15% drop. Now, some people are going to say, oh, is this a hopeless case? Aren't we supposed to invest in the Philippines anymore, Rex? This is but natural. I'm not going to, undermine the Philippines' propensity to bounce back. This is a natural market progression because when I say when I tell people, don't get spooked with what you see on the short term, because just by looking at it from where the pandemic started, can we move on to that next slide? I will show you a very different picture. And that picture is this, that from the drop of March 2020, the Philippine market is actually recovered 53%. That is a 53% hike from the drop in March to early 2021. 53%. So a retracement of 15% is natural. We don't even have to make a reasonable excuse of the recent surge or the recent MSCI rebalancing. There has to be a correction. It cannot be a straight line fashion. But we will have to admit, while it's happening to our country, other countries are experiencing a very, very different investment outlook. Can we move on to the next slide? See, this is how our recovery would have been projected. Okay, you will see here that we were supposed to be negative 5.4. We were negative, 4.2. So that's still a plus compared to the projection. But we're expected to have a surge on our second quarter and a normalization on our third and fourth quarters. So technically, if you're going to be comparing this to our ASEAN neighbors, we're going to be 2 quarters behind in terms of recovery to countries like Singapore and Vietnam. Next slide, please. So resilience is the issue. And what is resilience? It's that capability to bounce back from a sense of difficulty. It's that, capability to even thrive. Can we push on there's the text to go with this? Yes, the capacity to recover very well from difficulties and the capability to thrive despite the odds. So how do we now make our portfolios resilient? See, the key is this. Whatever is happening outside is happening outside. What do you have to do inside? Because what's outside you cannot control. What you can control is how you manage yourself and the way you manage your money. Next slide, please. You will see that asset allocation is the required solution. That we're actually investing not just to simply make more money, we're investing to achieve financial goals. So in the concept of achieving financial goals, we have to have resilient portfolios to make it a matter of time, not a matter of if. Let me repeat that. A matter of time, not a matter of if, for us to fulfill and reach our investment goals and objectives. So what is asset allocation? I've defined this in the next slide. Asset allocation is an investment strategy. It's an investment strategy that invests in different asset classes like time deposits, stocks, bonds, managed funds, real estate, insurance, and cash to build a portfolio that balances risk and reward on an investor's risk tolerance, time horizons, and most importantly, goals and objectives. So there are two facets to this, okay? It's the risk-reward spectrum and your tolerance for risk as an individual. So next slide, please. This is where we can see that we will have something called an efficient risk frontier. As we take more risk, there is an additional propensity to be able to earn a higher reward. But does it match us? What's our risk appetite? So the more risk you take, the higher the reward. But if you take too low a risk, there is no reward and you get eaten up by inflation, basically you lose more. So we have to put ourselves in a position to manage this, to make sure that, we balance things off so that we are in that efficient frontier, because markets evolve, markets behave very differently. So much so that asset allocation requires you to be in different asset classes, geographically diversified to make sure that you are protected. Moving forward, the next slide will show you, again, the time frame. So if you're having more time, you're young, 30, 40 years old, you can take much, much more in terms of risk because you have the time going for you. You have time long enough so that whatever happens, the market can give you the corrections for you to recover. But if you're very close to, like, let's say, retirement, or let's say the goals that you have to dial down on that risk. And this is why you can see here from 20s to 30s, 40s, 30s to 40s, up to the 70s, a person should be getting from a more growth-focused portfolio to a more defensive portfolio. And how do you do that? By getting exposed to different instruments and markets. So it depends now on a particular person. Again, I'm of the belief that there is no such thing as a perfect investment. No such thing as a perfect investment. The key that we have to follow is to make sure that we have what it takes to match our personal situation. How old we are, the risk appetite we have, and the kind of objectives that we have. Because this will impact you a lot. I want you to be able to remember this moving forward. Next slide, please. The fact that asset allocation is really the driver for long-term performance. See, many people spend a lot of time, choosing stocks, choosing actual investments. Now I hear a lot of people going into cryptocurrencies, wanting to earn more. But take a look at this. Where the money is really made, it's in the boring, methodical and systematic asset allocation. The lowest research results that I've seen is 65%. For this particular research, it's 91%. So security selection only make up 5%. Market timing only make up 2%. So the key to be able to do well for long-term investing is asset allocation. So you now get to think, am I concentrated on a market and am I concentrated on an instrument? Or have I really diversified? Next slide, please. So you're going to see how diversification increases portfolio resilience whether you are in a bull market or in a bear market. Let us see how investments actually perform. And again, if you don't remember anything from today from me, just make sure you remember this moving forward. Next slide, please. You're going to see, this is quite a mouthful here. You see, this is basically it. You don't have to drill down a magnifying glass and a microscope to see what's there. All it says is this. These are 16 years. A 16-year horizon. Philippine equities was number one in performance in 4 of 16 years. However, in 3 of those 16 years, the Philippine equities would be laggards. Ibig sabihin, over the lowest 2 levels of performance. So you will see in this particular slide different asset classes. Philippine fixed income, global fixed income, you will see US equity, global equity, gold, all of the asset classes are here. What does it tell you? Simple story. What does it tell you? That if you're just going to be in one asset class, you will not do very well in markets. The US might be only number 1 in the last 16 years in 3 of the 16 years. But it was never part of the last 2 strongs on that laggard category. Unlike the Philippine equities that became, tail-ender positions in 2016, 2019, and 2020 and 2021 were the laggards. So almost in the last 4 years. So that's the reason why some people even ask me, why am I doing so poorly? Because your exposure is in Philippine equities, and Philippine equities in the last 4 years would be in the lowest 2 strongs. Now, does that mean you won't recover? Obviously, there can be a recovery. There will be a recovery. But will you wait for a recovery, or should you be diversified so that you will perform much better no matter what happens to the market? I think that's the question. And if you're going to be looking at Asian equity there, the biggest component is China. So if you're going to be skimming through what the storyline here is, what it means is that the more diversified you are, the better asset allocation works for you. The better you're going to be in that pathway to a solid, consistent performance, so much so that your concentration is this. It's how much you need to invest. It is not where, it is not which. It's how much you need to invest on a regular basis. Take note of the number of years you need to particularly hit goals and objectives on a specific, solid timeline. That's the way to do things. If you're going to be running after the top performer year in and year out, you're just going to be losing this ball game. You will never win this. The important thing is to have the right amount of investment in the right, particular instruments to weather storms and crises. Next slide, please. So you're going to see the global vaccination campaign. You see how, the leading countries are doing it. And obviously, we're not even in these charts because we're probably part of the tail end, or probably even lower than the lowest quartile, right? Next slide, please. See, as this happens, you will see how the projections are. Like US, the consensus would be 6.2. For Fidelity, it will be between 5 to 9% for next year. For China, 8.5, between 9 and a low of 7 for Fidelity. Globally, 5.7, a low of 4.1 and a high of 6.9. See, if you're going to be looking at the world and the way it's going to perform, it's going to be more palatable. The Philippines, we're always into a gyration. Is that bad? Not exactly, because you can make a killing as well. But the important thing is this: if you're going for particular goals and objectives, are you putting things in the balance? It's very difficult for you to assume that the Philippines might be in a good year by the time you need to retire, or by the time you need to make a goal real. So much so that it becomes more predictable if you're in different assets, in different markets altogether. Next slide, please. So if you're going to be looking at this globally, you're going to be looking at the global business cycle. Look at the net household savings rate in the world. So all across the world, people are not spending. Can you just imagine what will happen when latent demand gets served and people get more, confident that they can now go out, they can travel and all that stuff? Next slide, please. See, as the global markets go, leading the way would be your US business cycle. You will see the weekly economic index of the US, and you're going to be looking at the manufacturing and non-manufacturing sectors. They're solid. So if you're going to be looking at being ahead, they're probably going to be 1 year, or at the very least 3 quarters ahead of the Philippines in terms of the recovery mode. Next slide, please. You will see consumer spending surging on the reopening and the stimulus checks. As we speak, there now are concerts and sporting events in Florida. There are now many places in the US that are open. And why? Because they've already vaccinated. You can have yourself vaccinated on drugstores. You can, in fact, there are even states and counties where they give you raffle tickets. You can win $1 million just because you had yourself vaccinated. They're even giving incentives. And you might not believe this, but in Washington state, this is real. They give marijuana joints, cannabis joints for people who want to be vaccinated. That's an incentive. It's legal in Washington, and you're going to be given a stick to be happier if you had yourself vaccinated. So in the Philippines, we don't need incentives, right? We want to have the vaccines, but they're not here. So there's going to be a bit of delay on that one. US personal income by component, you will see how it's trending higher. Next slide, please. So you're going to be looking at the US, that's going to be on the other side of the globe. Then look at China. There would be a robust structural set of drivers underpinning the new China. There is a consumption upgrade driven by a rising middle class and an increasing urbanization rate. I don't know if you've heard about it. but the Hermes shop in Shanghai recorded the highest sale of an Hermes store ever when the Chinese government opened its doors to that mall, and this high-end Chinese high net worth individuals were able to buy their bags. There is revenge shopping and revenge travel to follow, ladies and gentlemen. That is real. Technology is an enabler. They're creating very new business models in China, and this will well get into their bottom line as a country and making them into an economic powerhouse in the next 10 years. Next slide, please. You will see the fact that they're spiking in terms of production growth, and for their quarterly GDP numbers, can you just imagine this? This is real. This is already recorded. First quarter 2021, you know their growth rate? 18.3% GDP. 18.3%. So we're way far from that. We're still on the negative. So if you're going to be concentrating your investment in certain locations and geographic entities, you will be missing out in terms of big moves like this. Next slide, please. On top of that, you will see unemployment rates plunging, meaning everyone's going back to work. Household savings rate and disposable income, that has been high before. It's even getting higher at 37%. Unbelievable. The Philippine savings rate is below 18. Half of that. And the GDP breakdown, you're going to see what are the drivers of that breakdown. It's household consumption and capital formation. People are still investing in China. And we will see that getting stronger as we move along. Next slide, please. So, all told, all of us have that responsibility and we have to be accountable. So what do we need to do? Our total net worth will really have to be managed in a more optimal way of, optimal way of asset allocation, being involved in certain instruments, and making sure we balance things off between growth and risk. Again, the tax treatment to be able to lower the kind of leakages that we experience. Access versus liquidity. I guess this is something that's very important, and I'll discuss this a little later on. And lastly, distribution. How you're going to be leaving these assets behind when you go. So basically, wealth management or, comprehensive wealth management has to be done in this optimized way. It is not done in pockets. It's not done, in very short-term minded earnings-focused strategies. And that's why the person who invited you today, the financial advisor, financial consultant that invited you today, you will have to give them time to discuss these things with you so that you're in a better position to move ahead. Next slide, please. Will you now wait for things to get better? See, I have always told people, I always remember this. This is etched in my head. It's a quote by John Templeton, one of the cornerstones of the managed funds industry. And what did he say? Bull markets are born on pessimism. They grow on skepticism. They mature on optimism. And they die on euphoria. That's the way markets are. So if you're going to be waiting for things to recover, you're going to be too late. You have to position at the wrong time for many. And that's the reason why the bull market will be growing, because people are skeptical. People don't agree. When people are agreed, there is no more money to get made. Next slide, please. You see how infections drop after vaccinations. This is the way the cases dropped in the US when they started. This is March. Haven't even talked about April and May. April and May, that's going to be much lower than this. How about the UK? Next slide. Check out the UK. Look at that kind of vaccination and the kind of drop in terms of infection. Look at the blue line. That's why as you vaccinate faster, you will see infections going lower, and with infections lower, more confidence in the market, the economy is going to blast its way into a recovery. Next slide, please. So, history repeats itself endlessly for people who are unwilling to learn from the lessons of the past. I've seen this happen. 1997, I've seen it happen. 2008, I've seen it happen. By 2012, people are telling me, friends are telling me, you know what, Rex, I should have invested, no? In 2008, it was so cheap in 2008. I should have invested. And here we are, fast forward a few years, we're in another crisis, and those same people are not investing again. Guess what they're going to say in 2025 and 2026? They're going to be having the same mindset. They're going to be having the same lines of missing the boat and hoping another crisis comes along. Next slide, please. And that's the reason why I'd really want to press on with this idea of this instrument. You know, the VUL policy. It has also gotten a bit of bad press from some people, maybe because people don't really understand the way they work. You know, they're a combination of life insurance and investments. And people are saying that, you know, it's investments that's an excuse. It's really an insurance product. Or is it the other way around? That insurance is the excuse and it's really an investment product. I guess we get confused because it's exactly the product per se. It is dependent on how you use it. It can be more of an insurance product if you use it more that way, or it can be more of an investment product depending on how you translate your VUL to work a certain way. This is all tailor-made. See, it's not like a combination that somebody cannot custom build for you. That is key. Next slide, please. I'd want us to understand, and you can ask your financial advisor to help you out, because this is the product that can give you the discipline. You know, I've heard this too many times, you know, buy term, invest the difference. It's real. It's cost effective. I'm not going to say it's not. I'm going to be lying to you if I say it's not cost effective. It is. But what's my beef with that? Check the research out. How much of term insurance lapses? How much of term doesn't get followed through on? It's buy term, invest the difference, but in the real world, guess what really happens? It's buy term, eat the difference. People forget. People don't continue investing. Why? Because they can opt not to. Especially Filipinos. If you tell a Filipino that, you know, you can pay this, or if you don't want to this year, don't. Guess what they're gonna do? They won't. And if they won't, what will happen to the plan? What will happen to the objective? What will happen to the trajectory? And that's the reason why I even get caught in some of these debates and, you know, discussions where I say, you know, in a VUL, you're actually buying discipline as well. You're paying for discipline as well. Because this is not a combo product that you get in McDonald's. You see, in McDonald's, you buy a Big Mac and you buy fries and a drink. That's more expensive, right? You put them together in a combo, that's cheaper. Great. But you see, you're going to consume that in an hour. The critical sense in combining these things in a service like insurance and investments is the fact that it doesn't take 1 hour to consume. It doesn't take 1 day, 1 week, 1 year. It will take decades to understand and see how things are going to perform. And if you don't have the diversification, you don't have the investment experience, and the service of an advisor to go with it, you're certainly going to be missing out. And definitely with the extras that are supposed to be provided, because I know I've been president of an insurance company. Extras like riders and the critical ones that really matter, they're not allowed to get attached to term policies. They are in VUL policies. That's very important as well in the discussion of the VUL plans. But you see, you can also invest in many instruments. See, that's the reason why a lot of people like BTID. I'm not going to be forced to invest in funds. I can invest in anything. And because you're given the option to invest in anything, guess what you're going to be investing on? Nothing. That's exactly what happens. And again, I go back to my statistics. How much of term insurances lapse and how much of investments actually continue. When people say, okay, I'll invest in my own fund, will you do that on a consistent basis, monthly, quarterly, or annually? If you're not given an option to, I will tell you, you won't. That's natural. That's human behavior. And that's why I always say this. Money is behavioral. It's not technical. The job of a fund manager is technical. And that's the reason why a fund manager does very well for funds of other people. But there are times when he doesn't do very well on his funds, because for his funds, he's going to be involved emotionally, and he's going to be having greed and fear associated with it. But if you're managing a fund, you're going to be very objective. Why? Because it's not your money. It is not your money. So it's very clear that we have to see, VULs for what they really are, for their benefit. You see, I don't exactly tell people buy insurance for what it is. I always tell them buy insurance for what it will do. For what it will do for you. And what it will do for you is not going to be visible in a year or two. It's going to be visible in 5 years, in 10 years. It's going to be very visible once it gets to the fulfillment of goals and dreams. Financial goals and dreams. Next slide, please. So the VUL policy gets you down to a level of diversity that reduces your adversity. It's exposure to many instruments and exposure to many markets. And that's the reason why I was, happy to be part of this event when I got invited, because, technically they're going to be launching, Manulife is going to be launching the funds that I actually just simply talked about in terms of markets. And I got surprised that they're going to be making it available in the local market. And that's very important because access is another thing. You see, I go from way back, and from way back, you have to have a private banker. You have to have millions upon millions of pesos or dollars to be able to have access to funds like this. And here we are today. They're available to you. They are available to people around us for amounts that are ridiculously low. I cannot imagine it during my time. Next slide, please. So key is to look at this because it's real. For 2021 and 2022, the key factors would be selectivity and diversification. We have to be selective and we have to be diversified in our investments. We have to pivot and repurpose our businesses. This will be the strategic anchors for these next 2 years. And if you're going to miss out on this, then you're going to be putting yourself in a bit of risk. And my slide is this. My last slide is this. See, we don't do these things for ourselves. If we just do these things for ourselves, then probably we won't even be halfway through what we would have achieved. The real reason for us doing what we do is for the people we love. And I'd want you to use that as leverage. I'd want you to be able to use that as a fulcrum to be able to do better. Because if we do this for people who are special to us, then we will always have the motivation and the inspiration to do well. Grow our assets, grow and meet our financial goals and objectives. Again, most importantly, not for ourselves, but for the people who are special to us, the people who are special in our lives. Again, ladies and gentlemen, I give the floor back to Eileen. Thank you so much for your time. Thank you for listening to me. I'll be back again for a Q&A later on. Thank you so much.
Thank you, Rex. We appreciate your insights on how we can all benefit from insurance plans that are linked to offshore funds. I especially love your closing that we have to anchor on everything that truly matters. So that's going to be something I will take away from this session also. So to our audience, please feel free to type in your questions for Rex in the Q&A box at the bottom of your screen. We will see more of him later during the Q&A session. Okay, before we move on to our next speaker, we have another poll question for you. Now, this is a temp check to see where you are currently invested. So, are you currently invested in Philippine bonds? Or is it Philippine stocks? Are you in real estate or insurance? Or do you have UITF or mutual funds? Or are you now in using bank time deposits or none so far? So, please tell us where you are currently investing. What investment instruments you've been trusting so far. So we're seeing a lot of people saying insurance, if I'm not mistaken. Yes, it is. That makes us very happy. Okay, so majority of you are choosing insurance. Thank you. It's so nice to see that you guys are so engaged and are actually actively participating in these poll questions. We appreciate it, guys. And if you're not currently investing your savings or your hard-earned money, now is the time to do so, because investing in investment-linked life insurance plans and see your money potentially grow. Please consult a Manulife insurance advisor to help you assess the right product suited for your needs. Okay. Once again, thank you everyone for participating in this poll survey. And then moving on. Today, to update us on the latest market outlook, let me introduce to you our next speaker. So he's the head of wealth sales of Manulife Investment Management and Trust Company. He has more than 20 years of experience in retail banking and wealth management, is a chartered wealth manager, a registered financial planner, and an SEC certified fixed income salesman, and an SEC certified investment solicitor. So please join me in welcoming Mr. Zedric Matulis. Hi, good afternoon.
Hi, thank you, Eileen. Good afternoon, everyone. Thank you for joining us, and I hope you are all safe today. 2020 is over, and while we all would like to go back to the old normal, the pandemic has brought with it changes that will almost certainly transform societies in permanent ways, whether we like it or not. Today, I would like to discuss these changes summarized into three themes: their economic and market implications, and how investors might position their portfolios to benefit from them. Mr. Mendoza has mentioned a few of these trends already, and I would like to look at them in more detail. The first theme is technological disruption. Let's go ahead at the first major change in this theme, which is the great office exodus. Before COVID-19, estimates suggested that no more than a quarter of all full-time employees work from home. But since the pandemic, that number has climbed to at least 37%, with some estimates suggesting it is actually closer to 50%. In certain industries and areas, the current number is significantly higher than that. If you look at computing, legal, business, education, finance occupations, all of these sectors reported at least 88% of their employees working from home. I am sure the audience can relate to this, either as business owners or employees of companies that have used work from home to some extent. The second change on this theme is the shift on spending, and we can see that on the next slide. In the US, even before COVID, e-commerce was already above your usual department store sales. And this trend actually started as early as 2004. But COVID has increased that gap. And you can clearly see the gap increasing tremendously in 2020, with the green line overtaking the blue line by a big amount. More and more individuals have consumed at home, with less and less doing it at actual brick and mortar stores. As individuals, I think we can all relate to this. I mean, in the past few months, how much of you have spent more online rather than offline, or rather than in direct malls? I'm sure, just like me, most of you have definitely experienced a dramatic increase in online spending. The third change on technological disruption is the increased demand for data. Work from home shifts the demand from office space to a digital storage space requirement. This is definitely cheaper and more efficient for companies, and that's why they're exploring that. Video conferencing demands decent bandwidth. In the field of healthcare, trends like telemedicine and contact tracing require a heavy digital footprint. In the field of education, more and more have shifted from going to school to doing remote learning. In the Philippines, companies, schools, and even homes have upgraded their tech and comms hardware and software so that we can adjust to this new normal where data is very much important. Another change within the technological disruption theme is on the next slide. It talks about workforces becoming leaner. Manufacturers have been forced to rely more on automation during COVID, and this will linger even after that, simply because it's more reliable. Machines are generally more reliable than people. Artificial intelligence and robotics will permeate general purpose machinery in areas such as food, healthcare, consumer goods, and e-commerce, helping to better insulate supply chains from future shocks like pandemics and the like. Now, let us look at our second theme, which is the globalization. Okay, so this second theme, and the first change that under this theme is about travel. We do see evidence that travel will be more regional than global. More Filipinos will be choosing to travel once the lockdowns are removed, to travel regionally or even domestically rather than internationally. Long multinational business junkets are likely to be curtailed by companies, while international and vacations across regions are going to transition more likely to outings closer to home. The second item on the deglobalization is the decoupling of China and the West. Presently, for the US, for example, Japan and Europe, they import around 20% of their raw materials from China. And it is only prudent and expected for them to diversify elsewhere, not? So obviously to reduce risks of having to import from one location. China, on the other hand, will also de-emphasize its reliance on Western markets, accelerating the expansion of its internal value chains and nurturing the growth of a consumer-driven economy. With this, China will truly transform its economy from what used to be an export-driven economy. It's time to forget that China, which was believed to be the factory of the world, that will definitely change in the future as they become more consumer driven rather than export driven. The last theme is the revisit of policies and priorities. And the first major change on this shift is the shift from monetary policy to fiscal policy. And Rex touched on this earlier as well. In the global financial crisis of 2008, central banks unleashed heavy monetary policies like quantitative easing and negative to zero interest rates to support their economies. Today, during COVID, governments have realized that this is not enough, and it needs to be supported by fiscal support. The where we give money to people, or cheap money to people, fiscal support like that. No, and we believe that this will be the new trend. And what will benefit would be infrastructure spending, education, and increased incentives for low carbon technologies. And this will be the emphasis of governments. The second item on this theme is the growing demand for funds that track ESG, or environmental, social, and governance factors. More and more investors are less concerned about maximizing returns, but more on corporate responsibility. How companies consider the interests of all stakeholders, including clients, employees, shareholders, the community, and the environment. With this, we have seen more than $70 billion in net inflows to funds with ESG principles, bringing AUM to almost $1 trillion. Now, let us proceed to summarize the impact of these three trends that we mentioned. That will be on the next slide. Okay, let's put it all together with our view. The first one will be our view on the broad asset classes. As economies start to reopen, we expect economies to experience a post-vaccine surge in 2021. And Rex actually touched on this earlier. And an example would be the US is likely to see some of the best macroeconomic data it has seen in years. You see other countries taking advantage of loose monetary and fiscal stimulus policies, and this should drive equities higher. This is why, as an asset class, we actually prefer equities. The second asset class, we are more neutral. That is the bonds. Bonds can offer some protection from market volatility, although low and negative rates globally provide little room for yield or for yield opportunities and for appreciation. Further large-scale drops in yields is very unlikely now, given the financial conditions that we are in right now, where interest rates are very low. So that's why we are a little bit more neutral when it comes to bonds. And finally, and Mr. Mendoza actually touched on this earlier, low short-term interest rates make cash, your money market funds, your time deposits, savings accounts, all of these asset classes with short-term duration, they make it very, very unattractive right now because of rates being lower for longer. So again, and because of that, we do not actually like cash as an asset class right now. Okay, and in terms of specific sectors that will do well, We can see from the themes that I mentioned before, like the great office exodus, the move to e-commerce, the demand for data, all points to certain sectors benefiting from these opportunities. You have technology, you have consumer discretionary, you have communications, and growth stocks in general will be the market leaders moving forward. Having said that, we'd like to be prudent, and as a fund managers, we like to balance that with targeted positions in other sectors on the value side, such as industrials, materials, mining, and financials. Okay, that ends my presentation, Eileen. See you again later for the Q&A. Thank you very much.
Thank you, Zed, for sharing the global market outlook this afternoon. We will see you definitely later for the Q&A segment. Now, we have another interesting poll question for you. This is for us to be able to understand each other better. So why are you guys saving up or investing? So what is the reason that you have for saving up or investing? Is it A, for your retirement? B, is it for your child's education? C, is it because you want to diversify your wealth and grow your wealth? Or D, is it setting aside for health emergencies? Tell us what you guys are doing or why you're doing it. Yay! So people, you guys are you're so good to us because you're actively participating in our poll questions, and we appreciate you for doing so. We see a lot of people setting aside funds for their retirement, and wealth diversification is a close second. Okay, so Manulife Philippines has insurance plans that can actually act as your retirement fund. These plans guarantee lifetime insurance protection for you and your family while securing your hard-earned money. And whether it's saving up or spending for essentials, Manulife's range of wealth plans can help you grow and diversify your hard-earned money, which you can savor when you reach retirement. Manulife Philippines has other products suited for all these needs, whether for retirement, for your child's education, for wealth diversification, and for health emergencies. We've got you covered. To discuss further on what Manulife can offer, here with us is a wealth specialist officer from Manulife Investment Management and Trust Corporation. He is responsible for the development and implementation of portfolio management communication programs for both onshore and offshore fund strategies on the Investment Link platform and Unit Investment Link platforms of Manulife. He works closely with the portfolio management teams of both Manulife IM Philippines and Manulife Investment Management in Hong Kong to support the effective communication and positioning of the ILP and UITF strategies. Friends, let us welcome Mr. Eduardo Chanco. Hi, Ed. Good afternoon.
Hello, Eileen. Good afternoon. Hi, everyone. I hope that you're all well and safe right now. Did you enjoy the first two talks? Well, I know I did. I learned a lot from our mentors here, Rex and Zed. So for this portion, I'm happy to share with you our newest fund offerings that you can invest in. These are three unique strategies that offer diversification benefits to your portfolio of investments. Diversifications, as we have learned, is simply not putting all our eggs in one basket. It is a basic but very important tool for investing one's money. Are you excited to learn more about these new funds? So now let's get the ball rolling. The first one is called the US Growth Fund. We will see what the rationale is for investing in this fund on the next slide. So the question on your minds right now could be the one also stated here, which is, why the US? Now, the reason for this is because the US is the largest economy in the world. It is home to the biggest companies that have been established. In fact, if you will see in the table on the right, 8 out of the 10 largest companies in the world are US companies. This also shows that their impressive market value. These companies are called large cap companies because they have large market capitalization of more than 10 billion US dollars. They represent approximately 93% of the total US equities market. Large cap stocks tend to outperform the market during the latter years of the expansion phase of the business cycle. The companies listed here are among the best in the world. You may know some of these names since we use their products and services ourselves. As an investor, it is a good move to have exposure to the US market in the same way as what most global investors are doing, as what Sir Rex mentioned. Next slide, please. Now, another reason to consider this fund is because it is invested in a diversified portfolio of US companies. These have already been very carefully selected and studied by the fund manager for you based on their assessment of the company's potential. These are the companies from various sectors or industries such as information technology, telecommunications, financial services, and consumer companies. As what Sir Zed mentioned earlier, these are the sectors that will benefit from opportunities brought about by new structural trends or new ways of doing business. They are positioned to take advantage of long-term growth potential as people adjust to the new normal. Next, please. Now, to give you an idea where the US Growth Fund is invested, here are the top 10 holdings of the fund. So this appears to be similar to the logo quiz that we are so fond of, right? We're trying to guess what the logo is. So I guess you are familiar with some of the logos of the companies shown here. So let me ask you, how many of you have checked their Facebook account recently or used their Citi credit card to purchase something while using their Apple iPhone? So rather than just being a customer and using their products or services, you now have the unique opportunity to share in their success. As these companies grow and become more profitable, it can also affect the fund positively because the value of these companies grow as well. So now you know more about the US Growth Fund. Let's introduce the second fund that we'd like to share with you on the next slide. So the name of this fund is called Tiger Growth Fund. So the name of the fund is closely associated with a country in Asia, and the picture in the background is another clue for you guys. I'm sure some of you have already guessed that the Tiger Growth Fund is invested in China and Hong Kong. If we have a fund that is invested in the US, which is the market leader in the West, we also have a fund that can capture growth opportunities of the market leader in the East. So let me tell you more about that on the next slide. So again, the similar question on our minds is, why invest in China and Hong Kong markets in the first place? And the reason for this is also quite similar. Now, China has the second largest economy in the world, as highlighted in the table on the screen. It is second only to the US. It contributed 32% to global gross domestic product or GDP growth in 2019. And China's economy had the highest annual growth rate. Estimates say that China will have the highest GDP in 2030, replacing the United States at the top. China will drive global economic growth in the coming years as the world recovers from the pandemic, the International Monetary Fund predicts. Next slide, please. Okay, so this is where the market outlook of Sir Zed comes in, the one that he presented earlier, through fund management. Technology, deglobalization, and policy-driven directives are key themes that the Tiger Growth Fund subscribes to. The fund is positioned to take advantage of these structural trends and has investments in companies positioned in these industries that can harness this potential. The investment themes that the Tiger Growth Fund invest in are the following. Consumption upgrade theme, as more people are using digital means to work and study. There's also research and development, given the increased demand for social media and mobile gaming services, as well as 5G technology in telecommunications. Lastly, there are policy-driven measures as China beefs up its healthcare, infrastructure, and local industries to become more self-reliant. So in summary, the reasons to invest in the Tiger Growth Fund are the following. Access to China's large economy, diversified investment portfolio, long-term growth potential, and a resilient fund strategy. Next slide. So to give a better view of the Tiger Growth Fund, here's a sneak peek of the top 10 holdings. See here, I do not think we can do the logo quiz anymore as we are not that familiar with these companies. However, these are among the best companies in China and Hong Kong. Allow me to share with you a bit of more information on these. So the top holding is Tencent Holdings, and it is the owner of popular applications such as WeChat and WePay, as well as mobile gaming hits like Call of Duty Mobile, Clash of Clans, and League of Legends for those of you who love to play games on your mobile device. Tencent even produced Hollywood films such as Venom, Men in Black, and Top Gun, for you movie buffs out there. Now, the second company is called Alibaba. Some of you might be more familiar with this if you know who Jack Ma is. So it is the largest e-commerce platform and has other businesses in China as well. So for the rest of the companies on the list, you may Google them if you want to learn more. See, I mentioned Google because it is also in the top 10 holdings of the first fund that we talked about earlier. So let's take advantage of the Tiger Growth Fund, which can add value to your investment portfolio. So we are almost done, but we still have one more fund to share with you, and we've certainly saved the most unique for last. So moving on to the last fund. So the name of the third fund is called Global Preferred Securities Income Fund. So I know it's quite longer than usual. That's why we call it GPSI for short. So as the name mentions, it is invested in a different type of asset class, which is called preferred securities. We'll talk a bit more about that later. The objective of this fund is to maximize total return. So this can come from two sources. The first is from long-term capital appreciation, the same with the first two funds. So this can be observed as the price increases over time. Now, another source is from dividends. Yes, this fund has income payouts which are not guaranteed. Next slide. So allow me to share with you what are preferred securities for those of you who are hearing it for the first time. They are not stocks or what we classify as equities, and neither are they bonds or what we call fixed income investments. Instead, they are a mix or a hybrid of the two. In fact, they are right smack in the middle as can be seen in the diagram. Being a mix of the two, they share features that are similar to stocks and bonds. However, in this case, they are less risky than stocks, but riskier than bonds, giving them higher returns. So in terms of priority of payments, they also rank in between. Preferred securities are another means by which a company can raise capital for business and another avenue for investors to earn when added to their portfolio. Next slide. So these are examples of issuers of preferred securities. Financial institutions such as banks and insurance companies, utility companies, and even real estate investment trusts are some examples since they are highly regulated. This means that they need to have large capital and are overseen by a regulatory agency of the government. These are also good companies because they have cash generating capabilities and can pay out income to investors. They are also defensive in nature, meaning they are resilient even in challenging market conditions like pandemics. So this is because consumers still avail of their products and services. So next, I want to share you more about preferred securities on the next slide. Another reason why preferred securities are attractive is because of its high quality as an investment. These are mostly classified as investment grade, meaning they have a lower chance of default while still having a better yield. This is usually a requirement for global investors because before they invest in a particular country or asset, this is what they look for, that seal of approval or that minimum ranking that it's investment grade. So a lot of preferred securities are classified as investment grade. So this is a good chance to maximize the return of your portfolio without having to necessarily take on more risk than needed. Investors can sleep better at night because of this feature of preferred securities. Next slide. So this is one of my last few slides. Lastly, we'd like to share with you that this fund provides diversification by investing in several companies from different geographies. Although most are based in the US because of the sheer number of preferred securities that are issued there, there is also some exposure to Canada, Netherlands, and some parts of the world where preferred securities are issued. The table shows the top 10 holdings of the fund, and you'll see here that these are spread out among financial services and energy companies. These are publicly listed and highly regulated. Being a publicly listed company means that the reports about the company are readily available, and it also helps that a highly regulated company is safer in the sense that consumers have an authority figure to go to if there are any issues. So I know that these names are not common with the exception of a few big name banks that are there. However, again, you may learn more about these companies if you will find them all on Google. Okay. And going to my last slide, that's it. I briefly shared with you in a nutshell 3 of the new fund offerings we have in store for you. We hope that you will consider investing in them given the benefits that they can offer. Remember, a diversified investment portfolio will help in achieving your long-term financial goals. Tiger Growth and US Growth are available through the products as can be seen on the screen. Affluence Gold, Horizons, Affluence Builder, Education Builder, and Affluence Builder Plus, as well as Affluence Max Elite and Affluence Max Gold. While Global Preferred Securities Income can be availed through Affluence Max Elite and Affluence Max Gold. So it was my pleasure to discuss these new funds with you. Thank you all for listening and sharing your time today. Stay safe and healthy. And I'd like to turn back the floor to you, Eileen.
Thank you very much, Ned, for those insights and, of course, for updating us on Manulife's newest funds. I'm sure our attendees have become more confident about investing after hearing your presentation. So at this point, we heard our speakers talk about how an insurance plan that's linked to investment can help you reach your financial goals faster because some of the funds can be invested locally and internationally. And here in Manulife Philippines, whether you're a seasoned investor or just starting to build your wealth, we have a range of plans that can help you grow and diversify your hard-earned money. The good news now, as Ned discussed, is that we just launched 3 new international funds that you may invest in when you get a life insurance plan with us. We now offer the US Growth, U.S. Growth Fund, Tiger Growth Fund, and the Global Preferred Securities Income Fund. Through these funds, you can enjoy life protection while growing your wealth from across the globe. So if you want to know more about our products and you have an existing Manulife insurance advisor, please schedule a call or expect a message from them right after this webinar. Now, for those without an insurance advisor yet, please feel free to get in touch with with Manulife Philippines representative who invited you to this webinar. Or you may reach out to us by visiting our website. Flashed on your screen right now is a link and a QR code that you may scan to visit the Manulife Philippines website page. Okay, everyone, it's not too late to hit the Q&A box and ask your questions for our speakers. Right now, we're getting a lot of very good questions from the audience. I'm also excited to hear our guests answer all of these later on. But before that, please make sure to stay tuned until the end of the webinar because Manulife Philippines is giving away gift certificates worth 5,000 pesos. So please watch out for that. Okay, so now we bring back our speakers, Zed, Ned, and Rex on screen for our Q&A segment. So hi guys. There.
Hello.
Hi, welcome back. Are you ready to answer the questions in our Q&A box?
Yeah, ready, Eileen?
Ready. Okay.
Ready.
So I throw the first question to Zed. Okay, what can you say about the Philippines' current state of the economy in relation to the Philippine stock market?
That's a great question. We believe like what Sir Rex mentioned earlier, we believe all economies in general are expected to reopen and hence recover as soon as the vaccine rollout reach a large enough portion of the population. This includes the Philippines, and this is not a question of if, but a question of when. And also along the way, however, there might be short-term headwinds like temporary surges in cases like that. No, this is why we recommend investors to diversify and look at getting some exposure to markets that may be well ahead of us in vaccine rollouts, like the US and China.
Thank you, Zed. You mentioned looking at diversification. To Rex, is there a recommended percentage for the amount of investments that you put in offshore?
Normally, I would probably look at a minimum of 20%. Usually, I tell a lot of people the rule of thumb will be 20 to 25%. But the current landscape actually tells me that, you know, temporarily you can even have something higher than that because of the way, you know, things are going to be. As Zed mentioned, we might be probably part of the laggards as far as this vaccination game is concerned. So technically, there would be a better proposition to be exposed to different markets who will have an edge against us when it comes to that particular direction. So I would probably go, again, rule of thumb, 2025, but if you can increase that a little bit because of the situation today, I think that would be advisable.
Thank you, Rex. Now, to Ned, there's a question for you. Is there a distinct advantage if the team managing your funds is based in the country where the investments are being made?
Thanks for that, Eileen. Yes, having a team on the ground really helps in having a more organic feel of the market. News is seen firsthand and immediately, and it allows the fund manager to adjust quickly to market events that can result to better fund performance.
Thank you, Ned. Thank you. Now, Rex, there are a lot of questions for you here. For a person with an investment horizon of 10 to 20 years, what sector in the stock market do you think has a high potential growth, and where do I position most of my portfolio? They're picking your brain already.
When you say sector, we're talking about the local market or the international market?
The question doesn't say, but it's more of a general statement.
Yeah. So I would probably answer those questions differently. If you're saying local market, I cannot help but again hold back and say easiest to deal with would be the essentials. The kind of companies that will continue to earn given the situation that we have, and we've seen them. We've seen them perform last year, even when the economy was at the doldrums. Particularly, companies like tuna like DNL, companies like Pure Gold. These are companies involved in essentials, and certainly their sales revenues and net income would be even enhanced by the pandemic. Not far behind would be the telcos, because what I like about them is that they also have a very good business portfolio for the pandemic, but they also give out good dividends, which is much higher than what people are getting from their fixed income instruments. However, flip side, when I'm asked about the international markets, I'd probably focus again on the growth sectors of technology, like exactly what Zed presented earlier. That would be the best bet, because the writings are on the wall. Human behavior, the way we consume, has actually changed a lot over time, and even got accelerated with this pandemic. So I'd put my bets on something that's aligned with exactly what Zed said.
Rex, there's a follow-up question. So now they asked about the sector. Now they're asking, between China and US, where do you place your recommendation to invest?
On a personal basis, I'll be choosing the US. On a personal basis, there are going to be headwinds in China, while when I say US versus China, it's not China against the rest of the world, right? They can be my top positions for my portfolio moving forward, but between both of them, I would probably say that there are better selections in the US, because again, going back to technology, going back to companies that have controlled the global internet/online and digital businesses and products, they're quite ahead.
Okay. Now, thank you, Rex. For Zed, this is a personal question. I have a friend who invested their funds in equity feeder funds, and so worried because the fund is going down. How can I pacify his worries and fear?
Okay, it's really difficult to answer that question because the question did not specify which geography that particular equity feeder fund invested in. But I guess it can be in global equities, or probably a Philippine equity feeder fund or something like that. That's why they're not performing well. But if you have invested, for example, in the US or China or Asia in general the past few months, you are doing well definitely right now. So maybe that answers the question. That's not any of the three, that question that is being asked. No, so I guess if you're still there, like I said, generally speaking, equities are expected to recover, not uniformly. Some will be ahead of others, but if you are a long-term investor, you really like, not knowing what the particular asset class that person was asking about, I guess generally speaking, it will be good to stay invested, be true to your long-term diversification view, and long-term and diversification view. These two things are still very important.
Thank you, Zed. Now, for Ned, do you see liquidity issues in the preferred securities? And if you do, how do you deal with it?
Great. Again, great question from the audience now. So that's one concern for investors is liquidity, right? If you're holding onto it and you can't sell it now. So the good thing about preferred securities is that we're talking about global preferreds here. And the size of this is in the billions of trillions because these are global issued. In the Philippines, it's kind of hard to compare because we have very few preferred issues here. These are normally preferred shares issued by the top companies like San Miguel, PLDT, ABS before, right? But we're talking here about the global securities market, and it's a very huge market. So we wouldn't be going into it if we fear some liquidity concerns on the market now. So we can get in and out if we want to trade these securities.
Thank you, Ned. I now go back to Zed. What are the benefits of having offshore investments in this time of pandemic?
Great question. And I guess to put it simply, the key word here is diversification. Not just during this time of pandemic, but more importantly, during times of volatility, it's great to be diversified. Not just invested in one country or one asset class, because you never know which country will do better or do worse. And that's why it's important to have some money, some exposure, like what Rex mentioned, in offshore asset classes.
Thank you, Zed. Rex, back to you. What are the risks involved when investing in offshore funds, and how can we prevent it?
Okay, there are a number of risks, but that's going to be that's going to be really a question that we should get to break down into bits and pieces, because by not being where you're investing, you're already exposed to a certain level of risk. So compare that to a person who's in the Philippines investing in the Philippines and a person in the Philippines investing abroad. So key is to understand that there can be currency risks, because we're going to be holding on to assets that are not exactly valued in our currency. So technically, you're going to be exposed to the movement of currency. Second, you're also going to be exposed to certain levels of liquidity and credit risks. It's very different knowing the state of affairs of the country and knowing the essentially that the kind of liquidity and volatility that's happening to you, because you have access to information. You might not have exactly the same access of information when you're investing abroad. And certainly the last one would be performance risks. See, it's very easy because, like, we know, I mean, companies that have been mentioned, San Miguel, PLDT, Globe, I mean, we know for a fact how they're doing because we're in this market. But if you're looking at investing in instruments in other markets, it might be quite a lag time for the news to get to you. That's an issue. So, I mean, how do we mitigate this? I will always mitigate it by having a professional fund manager, by having somebody on the ground, by having somebody who's exposed, who will have the right information, because he has to act on those information. See, before all of this information gets to somebody in the Philippines, you've already lost a lot of time. Some people have already made decisions. So as I invest, there are very few international investments that I deal on a very direct basis. For most part, my international investments are managed funds.
Thank you very much, Rex. Now, Zed, we have a very active audience this afternoon. Given the data presented earlier and knowing that we are still in the middle of a recession, do you think now is the best or the safest time to invest in investment-linked insurance plans?
That's a great question, Eileen. Investment-linked insurance plans give investors a convenient way, like what Rex mentioned earlier, to invest and protect themselves at the same time. And this is important in any phase of the economy, and even more important in times like this. Without these types of funds, Filipinos would not have the capability to easily diversify and invest in US, for example, or in China. For example, if you're a Filipino right now, you want to get exposure from Facebook or Apple or Microsoft, or a great utility company issuing preferred securities in the US, or a tech company like Tencent in China. It's very hard to do it, without these funds. You have to find a way to talk to a foreign broker, shell out a lot of money, take a lot of actions to do that. But VULs like this one that Ned mentioned give this very convenient and easy way for us to invest and protect ourselves. And protection is very important during these uncertain times, as obviously you would want your family to continually have a way of living that they're used to should something happen to you. So I guess that's the power of investment-linked insurance plans.
Thank you, Zed. Now, Ned, is it safe to say that our market will mimic that of China's once we recover?
Yes, we can expect markets to recover after the pandemic, since problems related to this would already be addressed. Now, this includes the Philippines. As markets are unique, however, they will have different pace of recovery from one another. So we are already seeing some improvements in the Philippines, and with positive developments in vaccine and COVID response, hopefully in the future, then a recovery will follow suit as well.
Thank you, Ned. That's very good to know. Now, Rex, how does offshore investing complement my existing local investments?
Oh, as mentioned earlier, if you remember the chart that I put out there, not a lot of investment instruments, specifically the ones that are in different jurisdictions, act the same way. So certainly, if we have certain issues and problem with the Philippines, there will be another area or part of the globe that should be doing well. And that's the reason why, astute investors will have to have exposures in different markets. No, what I like about that question is that it's quite insightful in a sense that it's someone's decision, but technically you have these propositions to lower the kind of risks that you're taking, and also the flip side of that is also to improve the kind of performance you're gonna get. So the important thing is how to make these things blend together, because you cannot be putting all your eggs in one basket while you love the country, you love the Philippines. If all your money is here, and you know how it is. I mean, we're not exactly born yesterday. We've seen all of this volatility over time. We're gonna be having elections next year. How would we know the next 6 years and how people are going to be reading that? So clearly, there is a call to diversify. There is a call to do a lot of good asset allocation, and it will benefit us, as Zed mentioned. I mean, having that kind of a spread, evens out over time.
Thank you, Rex. Now, I think we're down to our last few questions. Zed, what is the outlook on the Philippines and US dollar foreign exchange? Do we expect the peso funds to perform better than the dollar counterparts?
That's a great question. Right now, we have a neutral outlook on the Philippine peso US dollar exchange rate, because we believe that the general weakness of the US dollar globally will be balanced by a potential weakness in the Philippine peso anyway, since our economy is going to reopen and importation will start to pick up. So I guess those two contrasting factors will balance each other out. Therefore, for clients who are looking at investing, I think the foreign exchange should not be the biggest concern. The biggest concern should still be diversification. And if you have the capability or the ability to invest in an offshore strategy, go ahead and do it.
Thank you very much, Zed. I think, unfortunately, that's all the time we have this afternoon for our questions. But before we let our speakers go, I would like to ask each of them their final tips for our audience. Can we start off with Ned?
All right. So we encourage you to practice diversification with your investments. Look for strategies that are offshore and complement local funds. Consider investing into funds that have different securities from each other so that your investment portfolio is well diversified. You may start looking at our 3 new funds, which can help you do this. Thank you.
Thank you, Ned. I move over now to Zed. Any last words for our guests this afternoon?
Diversify. You do not know which asset class or which country will do well or do worse in the short term. Let Manulife be your partner in diversifying so that you can achieve your financial goals. Thank you and stay safe, everyone.
Thank you, Zed. Now, finally, of course, Rex, what would you like to leave our audience with this afternoon?
You made me last, Eileen. I am going to trust that that's not due to age, but to beauty. Seriously, I guess the age shows, no, and I'd want to jump off from that. I've been through many different cycles in this market. I've been in the industry for so long. I've been through many crises, and I can tell you, without batting an eyelash, it is when money is really made. The best times to invest would be when a crisis hits, and that's the message I have for everyone. Do not waste this crisis. Do not let a good crisis go to waste, because it's a good time to go forward in our investment journey. Thank you, Eileen.
Thank you very much, Rex. Thank you, Ned and Zed. Thank you for a very insightful afternoon. You've shared a lot of information with us, and I hope you guys, our audience, are still with us and that you've learned a lot from us this afternoon. And right now, we are going to be raffling off the 5,000 peso worth of Sodexo gift certificates I mentioned earlier. And the winner of that gift certificate is... Can we flash that now? Congratulations, Raquel Remonte. A representative from Manulife Philippines will get in touch with you on how you can claim your prize. Congratulations, Raquel, and thank you for joining us this afternoon. Now, I would like to thank everyone who joined us this afternoon for taking the time and for actively participating during our Q&A. Thank you again to our wonderful speakers. As you set your short-term and long-term financial goals, we hope that our offshore investment funds can help you achieve financial success and security for you and your family's future. We'd like to hear your feedback on this afternoon's webinar. Simply scan the QR code on screen and answer our 2-minute survey. We'd love to hear what you think and how we can help you in the future. And this wraps up this afternoon's Financial Wellness webinar. This has been your host, Eileen Janicio. We hope to see you in our future webinars. Maraming salamat and stay safe, everyone. Have a nice afternoon.
You deserve the best life. You work hard. You know the formula for success. Your options are wide, but few make the cut. We can help you make the most out of life. Because you deserve the privilege that comes with building an elite life. Introducing Manulife Affluence Max Elite. This one-time investment in life insurance plan provides you with a startup bonus that would optimize your funds on the onset so you can enjoy rewards now and in the future. Experience the Manulife Affluence Max Elite Advantage. Let's say you put in a one-time investment of 1 million pesos. Manulife will give you 1% of that as a startup bonus. This increases your investment by 10,000 pesos. Assuming that the funds grow by 8%, your investment can grow to almost 5 million pesos. Get a loyalty bonus. If you stay invested, you may have the chance to get a loyalty bonus on the 10th, 15th, and on the 20th year. Enjoy hassle-free application through a guaranteed issue offer. This means that there would be no need for medical examinations if certain conditions are met. Get a boost on your investment by making additional investments anytime. Enjoy peace of mind with life insurance coverage. Invest through Manulife Affluence Max Elite. Get an early reward and look forward to more.
Sabi ko nun, ready for you 2020. What a lie. May pa-claiming it pang nalalaman. Wala namang ka-claim-claim sa taong to.
Papunta kaming Tagaytay. We're gonna visit Tagaytay.
Tindi ng pasabog ng January. Buti sana kung fireworks lang. Kaso, dumating ang unprecedented times. Lahat ng pwedeng mangyari, nangyari. Siya nga pala, Lola Nora ko. Siya lang ata ready.
Basta pang 2 years na to, ha?
Anyway, yun na nga. Nakulong sa bahay, nakaubusan ng bilihin. Pag lumabas, nakakapraning. Iniwalayan nung gusto mo makasama sana habang buhay. 7 years yun, Zoe!
Mabuhay ang bagong laya!
Naghanap ng kaadikan para di mabaliw. Mula halaman,
2999! 3,000! Oh, Miguel! Catch up with me! Di ba 25 ka lang?
at mga balik-alindog na program.
Happy birthday to me!
Nag-birthday mag-isa, kakalungkotin pala.
Happy birthday, Miguel!
Kung ano-anong sinubukan.
Ay, masyado matangos. Oh, better.
Kung ano-ano pa mga napagtripan. Kung ano-ano ang binili dyan. Di makapagpagupit, tinry na hindi mag-ahit, bumagyo, bumaha, ang daming nangyari.
Wow! Diba? Oh, galing ano?
Pero magbago na ang lahat. Huwag lang si Lola Nora. Last year sucked, but she was there to keep my spirits up. For that, thankful ako.
Hi, La.
Ano, Miguel? Ready ka na for 2021?